The sophisticated investors always move before anyone else. While the media celebrates prosperity and politicians preach never-ending expansion, a quiet minority is already slipping out the back door. They notice small fractures long before they turn into deep chasms. They detect the faintest hint of danger before the flames engulf the entire landscape. And in those final, calm moments before catastrophe, they move with discipline while the rest of the world sleeps through the warning. October 28th and 29th, 1929 were no exception. As millions of Americans fantasized about fortunes that would never materialize, the true power players were making decisions that would shape the next decade. The real question was never whether a crash was inevitable. It was what the insiders understood, when they understood it, and how they acted while everyday investors kept buying the illusion. The roaring 1920s had intoxicated the country unlike anything before. Stock prices doubled, then doubled again. Radio companies, automakers, and consumer brands saw their shares shoot upward month after month. People who had never touched the market were now borrowing heavily just to buy more stocks. Taxi drivers were offering advice. Shoeshine boys were debating price targets. Everyone was convinced the celebration would never end. But behind the excitement, a small group of seasoned professionals were watching completely different indicators. Joseph Kennedy, patriarch of the future political dynasty, was already preparing for disaster long before it hit. While the crowds rejoiced over new market highs, Kennedy quietly sold off his positions throughout 1929. The famous story claims he bailed after receiving a stock tip from a shoeshine boy, but the truth was far more strategic. Kennedy understood leverage better than nearly anyone. He knew that when the masses borrow to buy stocks, the entire structure turns fragile. One strong gust could topple everything. By late October, Kennedy wasn't just out of the market, he was positioned against it. Bernard Baruch, the legendary financier who had profited in earlier panics and advised presidents, had also been trimming his holdings all summer. Baruch had survived the panic of 1907. He recognized the signs. When speculation becomes feverish, when borrowed money floods in, when the crowd believes prices can only rise, that is when the fall becomes inevitable. Baruch later wrote that he sensed danger in the very atmosphere of Wall Street, the conversations, the confidence, the blind optimism. It reminded him of every disaster he had ever witnessed. By October, Baruch had converted most of his assets into cash and government bonds. He was prepared for the storm. But it wasn't only individual investors who sensed trouble. The Federal Reserve had been tightening credit in 1929, trying to slow what it saw as excessive speculation. Interest rates climbed from 5% to 6%. The message was obvious for anyone who cared to listen. Cheap money was disappearing. When central banks cut off the fuel, the blaze begins to die. Yet most investors ignored these warnings. They were too intoxicated by profits to notice the bartender closing the tab. Money from Europe had also begun flowing out of American stocks weeks before the crash. Foreign investors, especially the British, saw American prices reaching absurd levels. They knew that anything inflated beyond reason eventually collapses violently. British banks steadily sold their U.S. holdings throughout September and October. When the crash hit, their capital was already safe back home. The warnings were everywhere for those who understood them. Margin calls had been rising steadily for weeks. Borrowing to buy stocks means that even small declines trigger urgent demands for cash. If investors can't meet those demands, brokers liquidate their shares. By mid-October, margin calls were overwhelming brokerage offices. Smart money recognized this as a major alarm. If people were already struggling to meet obligations in good times, what would happen when conditions turned bad? To anyone experienced, the outcome was obvious. Trading volumes had also surged to record levels during October. On the surface, it looked like enthusiasm. In truth, it was a sign of distribution. Large investors were unloading their shares to smaller, inexperienced buyers. Professionals were selling to amateurs who still believed the dream. This is the pattern of every bubble. Insiders exit while outsiders pile in. October 1929 followed this script exactly. Even corporations were signaling danger to anyone paying attention. Company insiders were selling their own shares in record amounts throughout the year. When the people closest to the business start unloading stock, it means they know something the public doesn't. These weren't isolated transactions. They were organized, deliberate liquidations. The smart money inside companies was escaping just as quickly as the smart money outside. Jesse Livermore, one of the greatest speculators of all time, had been preparing for a collapse since early 1929. Livermore understood crowd psychology almost instinctively. He had made fortunes in earlier panics by betting against popular belief. As 1929 unfolded, Livermore accumulated massive short positions. He wasn't merely avoiding the crash, he was plotting to benefit from it. When stocks plunged, his bets would pay out spectacularly. By late October, Livermore was positioned for the opportunity of a lifetime. The bond market had also been issuing warnings for months. Normally, when stocks rise, bonds fall as investors choose risk over safety. But in late 1929, bonds strengthened even as stocks kept rallying. Many dismissed this as confusion. In reality, it meant sophisticated investors were quietly shifting funds from speculation into security. They were bracing for trouble while headlines proclaimed endless prosperity. International currency flows were also hinting at danger. The dollar had been strong throughout the decade, attracting global capital. But by autumn of 1929, subtle signs indicated wavering confidence. European central banks began collecting gold rather than dollars. It was a silent signal of distrust in America's financial system. When central banks withdraw confidence, private investors usually follow. Perhaps the clearest warning was the market's fragile foundation. By 1929, nearly 40% of all stock purchases were financed with borrowed money. Investment trusts, the era's version of mutual funds, borrowed to buy other trusts, which were also borrowing. It was leverage stacked upon leverage, a mountain of debt holding up overinflated prices. Savvy investors understood that once heavily indebted buyers are forced to sell, the cycle accelerates uncontrollably. Forced liquidation triggers more forced liquidation until the entire structure collapses. Professionals had seen this dynamic in previous bubbles and busts. They understood that financial gravity never disappears. Prices inflated by debt must eventually return to reality. The only uncertainty was timing, and by late October, even that was becoming clear. Smart investors were not simply exiting. They were positioning strategically to profit from the destruction they expected. While newspapers trumpeted a new age of everlasting prosperity, the true decision-makers were running very different calculations. They understood cycles. They understood bubbles burst. They understood leverage demands repayment. They had studied history, and history was preparing to repeat with brutal accuracy. To them, the crash was not shocking. It was the logical conclusion they had prepared for. The hours leading into the crash were filled with frantic phone calls, emergency gatherings, and desperate attempts to salvage what could be saved. But for those who had been tracking the signs, October 28th wasn't about fear. It was about execution. Their plans, formed over months, were finally ready to be put into action. On the morning of October 28th, trading began with overwhelming selling. The Dow had already dropped sharply the week before, yet most investors believed it was only a temporary dip in a long-running bull market. The professionals knew better. They recognized this as the start of the avalanche they had long anticipated. While amateurs held their positions hoping for a bounce, the experts accelerated their exit tactics. Jesse Livermore was especially active in these critical moments. He had been building short positions for months, but on October 28th, he dramatically expanded them. Livermore knew that once panic takes hold, it becomes self-sustaining. Margin calls force sales. Those sales push prices lower, causing more margin calls and more selling. It becomes a downward spiral that destroys everything in its path. Livermore positioned himself to capitalize on every stage of this collapse. Telephone lines connecting Wall Street to estates across Long Island were jammed with activity. Wealthy families who had accumulated fortunes over decades were unloading positions they had held for years. These were not reckless trades. These were calculated moves to protect generational wealth. Old money families remembered something newer investors had forgotten. Markets can erase decades of gains in days. Better to exit too soon than too late. European investors were making their final moves as well. British and German banks, still holding U.S. securities, were selling at any price. They had witnessed the American market inflate far beyond reason and wanted no share of the consequences. Transatlantic cables buzzed with sell orders from London, Paris, and Berlin. Foreign capital was racing out of America as fast as the technology allowed. Corporate executives were having their own reckoning. Many had been granted stock options worth fortunes, but only if exercised before the crash erased their value. Throughout October 28th, insiders converted these paper gains into cash with haste. They knew their businesses deeply, and they saw the economic storm gaining strength. Meanwhile, the Federal Reserve monitored events closely, though its actions remained subtle. Officials had held emergency discussions throughout October, debating responses. Some wanted to lower rates to support the market. Others argued the speculative excess needed to be purged, regardless of the pain. While policymakers argued, smart investors were not waiting. They were enacting their own measures. Bernard Baruch spent October 28th working the phones, contacting his network across finance. Baruch had survived past panics by maintaining access to inside information during pivotal moments. What he heard confirmed his beliefs. The selling wasn't coming from small investors panicking. It was coming from institutions, banks, and wealthy individuals who had concluded the boom was finished. When large players act in unison, resistance is futile. Commodity markets were issuing their own warnings that professionals took seriously. Gold prices had climbed steadily in October, reflecting a shift towards safety. Oil prices were weakening as traders anticipated shrinking industrial demand. Agricultural goods were falling as farmers worried about financing upcoming planting seasons. Movements like these often foreshadow stock crashes by days or weeks. Professionals connected these signals while amateurs obsessed over stock tickers. Investment trusts faced a crisis of their own. These funds had borrowed heavily to juice returns in the boom. Now, falling prices triggered margin calls from lenders. Trust managers had to choose between selling prime holdings to raise cash or defaulting on loans. Either choice accelerated the decline. Smart investors understood this dynamic and positioned around it. Bank stocks were among the earliest to crumble on October 28th. Professionals knew banks were deeply exposed through loans backed by stock collateral. If the market collapsed, these loans would become worthless. The early sell-off in bank shares was not random. It was informed speculation by those who understood systemic risk. Despite falling prices, plenty of voices called for calm. Newspapers advised patience. Officials spoke optimistically. Corporate leaders made reassuring statements. But smart investors ignored the speeches. They studied order flow, credit markets, and the cold math of collapse. The options and futures markets, small but meaningful in 1929, also signaled trouble. Put options were trading in unusually high volumes. Sophisticated investors weren't only selling stocks, they were purchasing protection. This wasn't confidence. This was preparation for disaster. As the day continued, selling intensified. What began as orderly liquidation by experts started to spark fear among smaller investors. Margin calls flooded brokers. Borrowers were forced to sell at precisely the worst moment. Smart money watched this forced selling with calculated detachment. They knew panic creates opportunities for those with cash. The final hours of October 28th set the stage for the devastation of October 29th. But for those prepared, the crash was not calamity. It was payoff. They had sown the seeds of their strategy for months. Now they were ready to reap profits from being correctly positioned when everything unraveled. The wealthy enclaves of Newport and the Hamptons buzzed with activity the night of October 28th. Secretaries worked late into the night coordinating intricate instructions with brokers to safeguard fortunes while the rest of the country slept. These were not frantic, last-minute decisions. They were meticulously planned operations months in the making. Old money families knew preservation required action before the crowd realized the danger. Joseph Kennedy remained extremely active during those hours. His team worked in shifts executing a strategy far beyond ordinary selling. Kennedy was simultaneously liquidating his last long positions while constructing huge short bets across multiple industries. He knew the coming collapse wouldn't hit all sectors equally. Some would crater harder. Some companies would vanish entirely. Kennedy's strategy was precise, targeting weak sectors while avoiding firms likely to withstand the downturn. Manhattan's exclusive clubs were filled with quiet, tense meetings that night. These weren't social gatherings. They were emergency financial councils where America's elite coordinated their next moves. Information flowed freely among this inner circle. Details about which banks were overextended, which companies carried dangerous debt loads, which industries faced extinction. It was insider trading in its rawest form, though entirely legal in 1929. Jesse Livermore worked from his private office, surrounded by multiple phone lines connecting him to brokers nationwide. Livermore had spent months studying how previous panics unfolded. He understood that massive gains came not just from predicting the crash, but from timing its phases. The first wave of selling allowed him to expand his short positions. The panic phase produced maximum profits. The final capitulation would signal when to close positions and prepare for recovery. Telegraph lines between New York and London were jammed with financial messages. British investors weren't only selling American shares, they were preparing to capitalize on the collapse they foresaw. The Bank of England had quietly built gold reserves for months, anticipating a rush to safety that would strengthen sterling. British merchant banks prepared credit lines to buy American assets at deep discounts once panic peaked. Currency markets hinted at the distress beneath the surface. The dollar, strong for years, showed subtle weaknesses. Swiss banks shifted dollar deposits into gold. French investors moved into government bonds. Even Canadian institutions reduced exposure to American banks. Smart investors understood that currency tremors often precede equity collapses. Corporate boardrooms across the country held emergency meetings as October 29th approached. Executives who had enjoyed soaring share prices for years now feared ruin. Some tried desperate measures to support prices. Others quietly sold personal holdings before the worst hit. The most astute realized their foremost duty was self-preservation, not shareholder reassurance. They had seen previous crashes destroy giants, and they refused to be next. The options market, though primitive, saw unusual activity before dawn on October 29th. Wealthy investors weren't just buying puts, they were also selling calls to harvest extra income from positions they planned to sell anyway. This was advanced risk management unavailable to ordinary investors. Professionals extracted value from every angle of the coming crash. Bank executives faced a similar reckoning as October 29th dawned. Many banks had issued massive stock-backed loans, now severely under-collateralized. Some quietly called in loans from reliable clients to shrink their risk. Others secured credit lines from correspondent banks to prepare for the liquidity crunch ahead. Smart bankers didn't wait for regulators. They built their own lifeboats. Commodity exchanges echoed the approaching earthquake. Gold futures climbed. Silver followed. Oil weakened as traders anticipated shrinking industrial activity. Agricultural commodities slumped as farmers fretted about financing future crops. These moves confirmed that the collapse was part of a wider economic slide. Investment trust managers faced a nightmare scenario on the morning of October 29th. These funds had borrowed heavily during the boom. Now falling prices triggered waves of margin calls. Managers had to sell prime assets or risk bankruptcy. Either option accelerated the decline. Smart investors had already positioned to benefit from the inevitable forced selling. Professional speculators weren't just betting against individual stocks, they targeted entire sectors they knew would crumble. Real estate, luxury goods, and consumer discretionary companies were favorite targets. These investors knew that during recessions, discretionary spending is hit first. Companies thriving in the boom would suffer most in the bust. The Federal Reserve made quiet moves behind the scenes. Some regional banks tightened credit to limit speculation. Others prepared emergency loans for institutions likely to face runs. The central bank was balancing intervention with restraint, trying not to worsen the crisis. Insurance companies also adjusted rapidly. Their large stock portfolios backed policy obligations. Executives feared collapsing prices would invite regulatory pressure. Some shifted into government bonds. Others hedged their equity positions. Their moves mattered. They were among the biggest institutional investors. Private banking relationships were strained as October 29th neared. Wealthy families moved funds to institutions they trusted to survive the chaos. These choices weren't purely financial. They were judgments about leadership and resilience. Smart money wasn't only protecting assets, it was choosing alliances for the aftermath. Market psychology shifted in ways only experts recognized. Trading patterns, spreads, and order flows signaled accelerating institutional selling. Small investors held on, hoping for recovery. Big investors moved with urgency. Professionals sensed the tipping point approaching. The moment selling would overpower all resistance. As dawn broke on October 29th, the stage was set for one of history's greatest financial collapses. But for those who had interpreted the signs, it was a moment of opportunity. Months of preparation had led them to this day. While millions would lose everything, smart investors were poised to gain fortunes that would last generations. They moved first, and they were about to be rewarded. The morning of October 29th erupted in chaos. Chaos that the informed had foreseen and positioned around. While the average investor hoped for recovery, professionals enacted the final phase of strategies that would define their wealth for decades. The opening bell triggered immediate, overwhelming selling. But this was not blind fear. It was controlled destruction executed by those who understood how fragile systems collapse. Jesse Livermore moved aggressively in the opening minutes, expanding his enormous short positions as prices plunged. He knew the real profits come not from the first leg down, but from the momentum phase where forced selling becomes self-perpetuating. Livermore had studied every panic since the late 1800s. He recognized the mathematical certainty of what was happening. When leverage unwinds, selling fuels more selling until the entire structure breaks. Communication lines between Wall Street and the rest of America jammed instantly. But smart money didn't rely on public networks. They had private lines, dedicated telegraph channels, and messenger systems that allowed them to execute trades while everyday investors waited helplessly for operators to answer. This advantage wasn't accidental. It was built specifically for moments like these. The crash of 1929 was not random misfortune for the insiders. It was a vast, coordinated shift of wealth, from millions who trusted the system to the few who prepared for its collapse. While the public watched their savings vanish, the smart money counted profits that would multiply over generations. The lesson is harsh, but eternal. Markets reward preparedness, not optimism. They reward those who read signals, not those who believe narratives. They punish the crowd and elevate those who stand apart. History may not repeat exactly, but ignore its patterns, and it will flatten you just the same.